Hello friends, let me welcome you to this video on Portfolio Manager Certification Examination, which is about multiple choice questions related to Chapter 3. Let me inform you at the outset that from 24th July, this particular module is going to undergo some change. So I would suggest that if you are preparing for this exam, it would be great if you can clear it before 24th, because changes, howsoever small, may impact your overall planning. The details of changes are available on the website of NISM, so you can go and read over there. But let me come back to this particular video and the objective of it. Like most of my videos, here also I'm going to take you through some multiple choice questions. These questions are based on chapter 3, which I have already said, and they relate to the equity part of the module, which means here this particular entire chapter is based on equity and concepts related to equity. So let me start with the first question, and I will be providing you answer parallelly, okay, by marking the right answer. So if you see here, the question is about which of the following is not true about market risk. So market risk, there are various aspects of market risk. We have four options here. Let us look at each one of them. Market risk is measured by beta, which is a correct statement. Market risk cannot be diversified. That is also a correct statement. Remember, market risk can only be hedged. Market risk can be diversified is actually not true. So this is what is the answer for the first question. Now we move on to the second question. Which of the following or which of the below mentioned risk is measured by impact cost? I'm sure most of you know that impact cost is something which helps us measure the liquidity risk. And impact cost basically shows the difference between bid and ask price of a stock, a bond, or any other asset class. Having covered two questions, we'll move on quickly to the third one, which is A hyphen or blank blank blank. Participate reference share is one in which dividend is paid usually at a fixed rate and not determined by company's earnings. So it's a fixed rate payment which will not vary as per the company's earning. This becomes a non-participating share or preference share. We move on to question 4, and it is about DVR or differential voting rights. If you remember, differential voting rights were introduced some years back, and they have some interesting features. So this question tries to explore that. Which of the following is true about the shares with differential voting rights? The first statement is shares with DVRs can have superior voting rights, which is correct, which means one DVR can have voting rights equivalent to two common shares. Shares with DVRs can have inferior voting rights, which is also true, which means that if you have DVRs with you, right, and if you have two DVRs, they can be equal to one common share. Shares with DVRs can have differential rights to as to dividend. So this statement is also correct. Invariably, or essentially, the option 4 or option D for question 4 becomes correct. We move on to question 5, which is rather straightforward. Which of the following is not the right example for sell-side research? Mutual fund often represents, or mutual fund actually represents the buy side of the research. So we'll go with mutual fund. Okay, here. Investment banking, broking, and advisory services are related to sell-side research. The next question is forward or leading P's are computed by dividing the current stock price with the sum of EPS estimates for how many quarters in the future, and it's about 4 quarters or in essentially 1 year. So this has already been marked, so this becomes our answer. And now we move on to the next one. Lower the PS, which means price to sales ratio, more attractive is the investment. So less it is, the more attractive will be the investment, which is true. Okay. Now this basically shows the relationship between sales and price. Okay. So when sales is more and price is less, then there is a possibility that price will go up in future. That is the reason lower is more attractive. In which of the following scenarios can price to sales ratio be used? Where do we use this? So price to sales ratio can be used instead of earning based ratio, as sales are less prone to manipulation. This is a valid statement to make. In case of companies not earning profits or companies with high volume, low margin businesses, instead of earning based ratio, investors can look at PS ratio to determine whether stock is undervalued or overvalued. Basically, both the statements are correct, so it is both 1 and 2. We go to a question which is again related to a ratio, which is price earning to growth ratio. So in which of the following scenarios is a company considered undervalued? So obviously when PEG ratio is 1, company is fairly valued. When PEG ratio is greater than 1, company is overvalued, and when PEG ratio is less than 1, company is undervalued. So answer is C for this. The next question is about which of the following measures economic profit produced by a company. So it's rather straightforward. Economic profit comes from economic value added, EVA, which is what we will learn as we go ahead in the subsequent slides. Market value added is a separate concept, which we'll also learn as we go ahead. EBITDA is all about earnings before interest, tax, depreciation, and amortization, and cost of capital cannot determine that for sure. So, what is market value added? So this is what I was telling you, is that market value added is a concept which we'll learn as we go ahead. So market value added is the difference between the current market value of a firm and the original capital contributed. So basically, when initial money is contributed by those who own the company, and it is an X amount, say 100 crore, and the current market value is say 200 crore, then 100 crore have been added, and that is what is the market value added. The formula market capitalization plus debt minus cash, all cash and cash equivalent, describes what? Is it market value? Is it net asset value? No, it is enterprise value. So enterprise value is what will define or get defined through this particular formula. Next question is, what is the reason for price to book value being used as a metric in the financial services company? Is it that financial service companies have very few real estates? Is it because financial services companies do not have intellectual property? Or is it because assets in financial services companies are marked to market? Yes, this is the reason that price to book value is used in the financial services company. So we have completed 13 questions. I'm sure you are enjoying this particular journey with me. We are left with 2 more questions. So let us see how or what we can do with those 2 questions. In which of the following industry asset-based valuation will not be used typically? Remember, real estate, shipping, and aviations are capital intensive or asset intensive businesses. So you use in all the 3 examples, but don't use in case of FMCG because they are not asset intensive businesses. And the last one is capital. If the capital expenditure goes up, it should be deducted while calculating free cash flow to the firm. We all know that this is true. Increase in capital expenditure as well as working capital results into deduction of it from the free cash flow calculation. This means that we have completed all 15 questions. Thank you so much for your time. Please write to me on healthofmywealth@gmail.com. And do not forget to subscribe to this channel.